the brokers give individual traders, anybody that open an account with them, leverage. Okay. For example, we've got leverage of 1 to 50. We've got leverage 1 to 100, 1 ratio 200, 1 ratio 500, and so on. Even some broker even offer 1 to 1,000. So I'm sure you must have selected this one at the process of registering for your brokerage account, because they do ask, your brokers will always ask you what leverage you want. And now here's another question that will come to your mind. Which one should I select? Now, at the end of this explanation, you will be able to best determine which one you should select based on your own personal preference. Do not allow anyone to tell you want to select because you are the one handling the account. It's highly based on what you want to achieve with that account. Maybe you want to flip it very fast, or you want to be very conservative with the account. That's what will determine on what you select on your leverage. So, but however, United States brokers always recommend 1 to 50 because that's what United States law allows. Because the more the leverage, the more your account is exposed. Okay, I'll be explaining that. So now, the broker is just like, what this simply means, 1 to 50 simply means for every $1 you fund on your brokerage account, every $1, it is viewed as $50. That's what this one simply means. For this one, for every $1 you fund, it's viewed as $100. That is, if you bring in $1 into the account, it's going to be multiplied by 100. For this one, it's going to be multiplied by 200, multiplied by 500, multiplied by 1,000, and so on and so forth. For now, let's say, for example, we are using a leverage of 1 to 100, and you funded a $1,000 account, $1,000 account. How much would that be? Okay, that would be 100,000 buying capacity you have on your account. And mind you, this money, this 100,000 is not going to be shown on your account balance. This will still be your account balance that is still displayed. Will still be this 1,000. But on the back end, the amount of forex pairs they are allowed to buy, you can buy product of up to 100,000. You can buy currency pair of up to 100,000. Okay. Meanwhile, you have $1,000 in your account. So it is the leverage that is helping you. Now, let's say, for example, we are trading on mini lots for a $1,000 account. Okay, this is our account balance, our balance. So we are using, for a lot size, I explain what the lot size is. We are using 0.10. That is one mini. Okay. That simply means for one mini, how many contract lot are we buying in that case? We are buying 10,000 worth of euro USD. Okay, we are buying 10,000 units. Let me refer you back to the last lesson so you can remember how we came about this lesson. Okay, can you see this unit here? This is standard lot size. For mini lot size, you see the unit you are buying is 10,000 units. 0.01, that's the volume. For micro lot size, 1,000. That is, for you to use 0.01, you have to have 1,000. So it is the leverage that allow you, even when you have $100, you are still allowed to buy 1,000 units worth of euros as against the dollars. While for standard lot size, you are purchasing, whenever you place one standard lot size, you are purchasing 100,000 units of euro as against the dollar. Okay, I hope that is clear. You now understand how I got the 10,000 units. So let's continue. Now, you are purchasing euro USD for 10,000. You are purchasing 10,000 units worth of euro USD of euro as against the dollar. So, and you only have a $1,000. Okay. Then there's an amount of money that you put down for, let's say, as at that time, the market was the price was 1.12000. Okay. That's the price of euro USD as at that time, and you purchased. So the amount of money that you put down will be, then the amount of money required to buy euro USD as at that time will be 112,000. Okay. Hope you understand. Will be 112. All I did is I multiplied this one by this. Now let me pull up my calculator so you do the calculation. All what I just did was, first let me clean. I multiplied 10,000 units by 10,000 multiplied by 1 0.12000. That's 11,200. Okay, 11,200. So I have to erase one of these. 11,200. So, and meanwhile, you've got just 1,000 in your account balance. What happened? They will only ask you to drop down some money. Like you should drop down for them. It's like a stake. You have to give them just 1% of this money, just 1% of this whole amount of money. And that 1% is how much? Is 112. Then they provide the remaining one. They will provide the remaining one. And this amount of money that you drop down will always be, it will be locked down in what we call margin. Now I'm explaining margin to you at the same time. In the next lesson, I will explain, but now let me focus more on leverage. So leverage is that amount of money. This is just 1% of the money. So you're only dropping 1% of the money. Then the 99% of the money is being dropped by your broker. Now, to get the 99% from this one, you have to subtract 11,200 from 112. All right, 11,200 from 112. Now let's do that again with the help of our calculator. Okay, subtract 11,200 minus 112 is equals 11,088. 11,088. So what the brokers will be providing is 11,088. 11,000. And you see, yours is just a fraction. Why the broker is providing this? They do this for all your trades. They do this for all any trades you place. So the money that is still left, you can still use that to be placing more trades, because they are always backing you. Now you will ask, why is broker giving me this such amount of money? Do they really love me? Is that why they are giving me and stuff like that? Not really. They're only giving you so that you will have an edge over the market, so that you'll be able to buy more volume, more than your money can carry. And then again, prior to this time, remember I told you that it's only bigger guys that are allowed to play in this forex market. Not that the forex market was not open to everybody. It was open, but you don't really have enough money to trade in the forex market. So they actually brought this leverage so that even with your small amount of money, with your small $200, with your small $100, with your small $1,000, you can still trade as much as the big guys are trading. So those times there was nothing like leverage, because you just go in individually without the help of a broker. You go directly, you buy and stuff like that. But right now, with the introduction of the brokers, that's part of their services. So for these services, for this leverage that they are giving to you, they charge you in form of spread, and if some broker, they charge in form of commission. Okay, so that's what they do every time. So they give you 99%, which we call leverage. I'm sure now you understand leverage. Now let me explain with this graphical representation I did. You see, for example, leverage of 1 to 100, you deposit your balance. This is your balance right here, $1,000, and you have $100,000. So this is your amount of money here. Then this is the leverage that the broker gives you. See, is a very huge sum. Why this one is so small? This is your personal money, and this is a leverage.